Assalamualaikum warahmatullahi ta'ala wabarakatuh. We are from Group 4. We will present about the performance of the company using the ratios. We has decided to choose Eco World Development Group Berhad to performing this task. Before we start, I would like to introduce my group member. So my name is Muhammad Fauzi bin Alias. My group member is Majidah binti Azmi, Nur Anis Amira binti Sabri, Muhammad Hakim Daniel bin Muhammad Hafendi, and Nurul Aina Najwa binti Ahmad Hesam. As I told before, we choose the Eco World Development Group Berhad, well-known public company listed on Bursa Malaysia. The purpose of this report is to understand how the company is performing financially and what factors contribute to its current state. The goal is to provide a comprehensive evaluation that highlights the company's financial position, operational strategies, and areas requiring improvement. We will look at the company's financial health by analyzing important financial ratios and trends over the past few years. Our presentation will include a background on the company, an analysis of its financial data, and a discussion about what the numbers mean. We will also share our suggestion for how the company could improve its performance and end with what we learned while working on this report. Now, let's start with the background of the company to get a better idea of its history and place in the market.
My name is Nur Anis Amira binti Sabri, matric number 292489. Background of the company. EcoWorld Development Group Berhad, commonly referred to as EcoWorld, is a public listed Malaysian company involved in property development companies, known for its innovative project and focus on sustainability. EcoWorld was founded in 2013 and soon became a major force in the Malaysian real estate market. It offers a wide variety of commercial, industrial, and residential real estates. The company has also expanded its reach to the United Kingdom and Australia market in 2015, aligning with its visions to become an internationally recognized developer. One of the company's early milestones was the development of large-scale township projects in Malaysia. Projects like Eco Majestic, Eco Sanctuary, and Eco Botanic showcase the company's commitment to sustainability and community-centered living.
Let's start with liquidity ratio. A liquidity ratio is a financial metric used to evaluate a company's ability to meet its short-term obligation with its most liquid assets. In simpler terms, it shows how well a company can use its ready available resources like cash or assets that can quickly be turned into cash to pay off its debts that are due within a year. This is crucial for assessing a company's short-term financial health and stability. They have three ratios under liquidity ratio, which is current ratio, quick ratio, and cash ratio. So the first is current ratio. What is current ratio? The current ratio measures whether a company has enough current assets to cover its current liabilities. It is calculated by dividing current assets like cash, account receivable, and inventory by current liabilities such as short-term loans and accounts payable. A current ratio above 1 suggests the company can meet its short-term debts comfortably. For instance, a current ratio of 1.5 means the company has RM 1.5 in current assets for every RM1 of current liabilities, indicating a healthy buffer. When we apply the current ratio in Eco World Development Berhad by dividing his current assets and liabilities, we get 1.58 times. In this case, the company has a current ratio of 1.58, meaning it holds RM 1.58 in current assets for every RM1 of current liabilities. A ratio above 1 typically suggests that the company has sufficient assets to cover its short-term obligation, offering a level of security to creditors and investors. The second ratio under liquidity ratio is quick ratio. This ratio is particularly useful for business that might have inventory that takes time to sell. A quick ratio above 1 indicates that the company can pay off its short-term liabilities without needing to sell inventory. It's a good indicator of a company's immediate liquidity and its ability to respond quickly to financial needs. When we apply the ratio in EcoWorld Development Berhad by dividing current assets minus inventory by current liabilities, we get 1.10 times. The quick ratio for this company is calculated as 1.10, signifying that it has RM 1.10 in more liquid assets for every RM1 of current liabilities. This is a more conservative measure of liquidity than the current ratio, as it considers only assets that can be quickly converted into cash. A quick ratio above 1 generally indicates that the company is in a relatively stable liquidity position, capable of meeting immediate obligation without relying in inventory sales. Thirdly is cash ratio. This ratio shows how well a company can cover its short-term liabilities using only its most liquid assets. A cash ratio of 1 or higher means the company can pay off all its current liabilities without needing to liquidate other assets or rely on revenue. While a high cash ratio shows strong liquidity, having an excessively high ratio may also indicate that the company is not using its cash efficiently for growth or investments. When we calculating cash ratio for EcoWorld Development Berhad by dividing cash and cash equivalents by current liabilities, we get 0.33 times. This company's cash ratio is 0.33, meaning it holds RM 0.33 in cash for every RM1 of current liabilities. A cash ratio below 1 is typical for many companies, as business often hold limited cash reserves compared to other current assets. However, a cash ratio of 0.33 could raise concerns as it indicates limited cash resources relative to short-term liabilities. In situations requiring immediate cash, this company might face difficulties, especially if there are sudden expenses or unexpected financial demands.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Hakim Dinian bin Muhammad Afindi, and my metric number is 295368. Now we continue to the next part, which is about financial leverage ratio. What is financial leverage ratio? This ratio shows how much a company relies on debt to finance its assets. A higher ratio means more debt, which increases both potential returns and risk, while a lower ratio indicates a more conservative approach with less debt. This ratio divides into 5, which are total debt, debt equity ratio, equity multiplier, time interest earn ratio, and cash ratio. Okay, now let me calculate total debt ratio first. The formula is total asset minus to total equity and divide with total asset, and we get 0.46 times. So a total debt ratio below 0.5 is seen as a sign of financial prudence, indicating that the company has a strong equity base to handle financial challenges. This balanced mix of debt and equity reduces financial risk, as the company has enough equity to cover its obligation. However, it also suggests the company may be too cautious with debt, potentially missing out on growth opportunities if borrowing costs low and additional funds could be used for expansions. Next is debt equity ratio. The formula is total debt divided by total equity, and we get 0.87 times. So this shows the company is using debt wisely without relying too much on borrowed funds. With a ratio below 1, it signals a lower risk, which is appealing to investors. However, this cautious approach may also mean the company miss out on opportunities for higher returns, especially in time of lower interest rates or strong economic growth. While the ratio suggests stability, it also points to a more conservative growth strategy. The formula for equity multiplier is total asset divided by total equity, and the answer is 1.87. So we can conclude the company is not heavily reliant on debts, reducing financial risk. Higher multipliers can indicate more debt and higher risk, but this moderate level suggests a stable capital structure. This conservative approach makes the company more resilience, especially during economic downturns, and is better equipped to handle financial challenges without risking solvency. Okay, now is about time interest earn ratio. The formula is earning before interest and tax divided by interest expense, and we get 2.2 times. So I suggest the company may struggle to cover interest payments if earning drop or interest rates rise. This low ratio points to potential risk, especially during economic downturns. It emphasizes the need for strong earnings or lower interest costs to maintain financial flexibility. A higher TIIE ratio would improve confidence in the company's ability to meet their obligation and secure additional financing. The last one is cash coverage ratio. The formula for this calculation is EBIT plus depreciation divided by interest expense, and the answer is 2.38 times. A cash coverage ratio of 2.38 times shows the company has more than enough cash flow to cover its interest expense, indicating strong financial stability. This healthy ratio provides a good cushion against debt, though the company could potentially invest more of its cash for growth. That's all from me. Thank you.
First, profit margin. Profit margin are a major focus for shareholder and management across every industry. High profit margin can increase the price of stock and determine the bonus awarded to managers. The formula for profit margin is net income divided by sales. Below the formula is the calculation for profit margins. The result of this calculation is 9.51%. The profit margin ratio yielding a result of 9.51% in this case. This means that for every dollar of sales, the company retained approximately 9.51 cents as profit after recovering all expenses. The profit margin provides an understanding of the company's pricing strategy and cost control. A higher profit margin suggests that the company can effectively manage its costs relative to its sales revenue, while a lower margin could indicate high expenses or insufficient pricing power. For example, a profit margin of 9.51% can be considered moderate, reflecting a balance between revenue generation and cost management. It suggests that the company is relatively efficient in its operations, yet there may still be room for improvement in reducing costs or increasing pricing if feasible. Second, return on asset. Return on asset is a measurement that can be used to determine how asset-intensive a business is. This ratio indicates how well a company is performing by comparing the profit it's generating to the capital it's invested in assets. The higher return, the more productive and efficient management is in utilizing resources. The formula for ROA is net income divided by total assets. Below the formula is the calculation for ROA. The value of ROA is 2.38%. The ROA results in 2.38%. This ratio indicates how efficiently a company utilizes its assets to generate profit. ROA of 2.38% suggests that each dollar invested in assets produces about 2.38 cents of profit. ROA is particularly useful for assessing companies in asset-heavy industries, where effective assets utilization directly impact profitability. A low ROA might indicate that the company holds excessive assets relative to its incomes, or it might highlight efficiency in asset management. Conversely, a higher ROA generally reflects a company's ability to derive more value from its assets, which is beneficial for long-term growth and sustainability. For investors, a ROA of 2.38% might suggest that the company has room for improvement in making better use for its asset base, which could be an area for strategic focus. Lastly, return on equity. Return on equity is a measure of how the stockholders fared during the year. It is also a financial ratio that measures how much profit a company generates with the money shareholders have invested in it. A positive ROE indicates that the company is generating profits on the money invested by its shareholders, while a negative ROE indicates that the company is not generating profits on the money invested by its shareholders. The formula for ROE is net income divided by total equity. Below the formula is the calculation of ROE. The value is 4.44%. The value of ROE is 4.44%. ROE is often considered one of the most critical profitability ratio as it measures the return generated on shareholders' investment. Essentially, it answers the question of how well is the company using shareholders' funds to generate profits. A ROE of 4.44% indicates that for every dollar of shareholders' equity, the company generates 4.44 cents in profit. This ratio is particularly important to investors as it highlights the company's effectiveness in generating return on their investments. A higher ROE is generally preferable as it indicates strong management performance and attractive return for investors. A lower ROE, however, could suggest that the company is not fully leveraging its equity base or that its profitability is relatively low.
Hi, my name is Majida binti Azmi. My metric number is 292571. Today I will present about market value ratios. There are three type ratios under market value ratio. First, price earning ratio. Second, earning per share ratio. And the last one is market to book ratio. The first ratio is price earning ratio. This ratio compares stock price to EPS, which is earning per share, indicating how much investors are willing to pay for each dollar of earnings. A high PE suggests growth expectation, while a low PE may indicate undervaluation or low growth prospect. The formula for price earning ratio is price per share divided by earnings per share. The price per share is RM 1.16, while the earnings per share is RM 0.06.43. The price earning ratio that we calculate and get is 18.04 times. A PE ratio of 18.04 indicates that investors pay RM 18.04 for each RM1 of earnings, reflecting balanced market expectations. This moderate level suggests confidence in earnings stability but cautious optimism about growth, appealing to value investors while offering limited attraction for high growth seekers. Second ratio is earning per share ratio. EPS represents profit per share, a measure of profitability. Higher EPS suggests better returns and can make a stock more attractive, impacting the PE ratio if the price remains stable. The formula for earning per share ratio is net income divided by sales outstanding. The net income is RM 189,323,000 divided by RM 2,226,862,000. So the earning per share ratio is 0.085. From the calculation, we can analyze that with an EPS of 0.085 RM, the company earns 8.5 cents per share, indicating profitability but room for improvement. Increasing EPS through enhanced efficiency or higher revenues could strengthen its appeal, particularly to investors favoring higher earnings. The last ratio is market to book ratio. Market to book ratio compares market price per share to book value per share. NMB over 1 indicates market optimism, while below one may signal undervaluation of financial issues, helping assess growth or undervaluation potential. The formula for market to book ratio is market value per share divided by book value per share. So the market value per share is RM 1.16 divided by market value per share is RM 1.62. So the market value ratio is 0.72. From the calculation, we can interpret that NMV of 0.72 means the stock trades below book value, potentially signaling undervaluation. This lower ratio might highlight market concerns about asset quality or growth, yet it could attract value investors who see potential for asset improvement or revaluation if performance strengthens.
Okay, now we go to the suggestion for the company. To enhance the performance of the company, operational efficiency must be improved to streamline process with lean management and automation to cut costs and improve productivity. Next is marketing strategy. They must enhance digital marketing with targeted campaigns on sustainability and innovation backed by market research to meet customer needs. And the last one is about innovation of the company. Company should be invest in new construction techniques, sustainable materials, and smart home tech to stay competitive and attract eco-conscious buyers.